I'm Bryce Knorr, Senior Editor of Farm Futures Magazine, and welcome to The Buzz for Thursday, October 11th, 2012. USDA's latest crop report sparked a strong rally in the market today. I'll break down the numbers, and more importantly, what they mean for prices headed into the post-harvest period. There were plenty of surprises today for sure. Let's start with the corn market. The government shocked us and much of the rest of the trade by cutting its forecast of 2012 production by only 21 million bushels, pegging the crop at 10.7 billion bushels. USDA lowered its yield, but raised its forecast of harvested acres. Exports were lowered, further offsetting the decrease in 2011 crop carryout found in the September 28th grain stocks report. Add it all up, and projected 2012 crop ending stocks were put at 619 million bushels, 114 million bushels lower. That was 7 million more than my guess, but lower than the trade expected. Futures rallied sharply in the wake of the report, and for good reason. Today's report projects a stocks-to-use ratio of just 5.6%, the second lowest in modern history if it holds. According to research I prepared for the November issue of Farm Futures, this increases the likelihood of the market making new all-time highs because there's a strong correlation between stocks and post-harvest rallies in short crop years. My forecasting model is also optimistic. It projects a selling range for the crop from 770 to 880 a bushel, territory we're only starting to enter. However, I think it's important not to get too bullish. For one thing, the market's dynamics may be changing from what they've been the past few years. Ethanol is no longer a growth industry for demand, and the funds don't seem interested in owning corn either, despite bullish fundamentals. The correlation between the dollar and corn prices is also weakening. That's been a major driver for the logic of buying commodities over the past 5 to 10 years. The market faces a major risk for the next couple of months on fears Washington is going to jump off the fiscal cliff, which could drive risk takers from the grain market. The good news is that prices are rising as the guarantee for revenue protection crop insurance is set. So as long as prices keep on rising, there's no need to make additional sales. Instead, consider running a trailing stop under the market at the trend line drawn off September and October lows. It comes in at 740 to 753 next week for December futures. With basis likely to be strong, either look for good carry to sell or use hedge-to-arrive contracts for any sales you make. Soybeans didn't get exactly bullish news today, but with the market beaten up over the past month, it didn't matter. USDA raised its forecast of 2012 production by a whopping 226 million bushels. The government found 1.1 million more acres, which we've been forecasting since our August survey. Yields went up 2.5 bushels per acre to 37.8 BPA, in line with the latest crop conditions report put out Tuesday. Adding in higher old crop carryout, and supplies available to the market rose 265 million bushels. Yet USDA raised its ending stocks forecast just 15 million to 130 million due to stronger exports and crush, though the average price for the crop fell 75 cents to $15.25. Still, without evidence of problems in South America, beans don't look like they have unlimited potential due to prospects for a big increase in production out of Brazil and Argentina. Even assuming USDA is too low on exports, which I do, my selling range is only $15.50 to $17. To be sure, November futures are just starting to get into that range, so I'd give this market some time. Just don't glue your rally hat to your head. I'm not convinced China's appetite for soybeans is unlimited. Their economy continues to weaken, and the government is going through a transition that's bumpy at best. USDA's news for wheat was mixed. Wheat followed corn higher so the spreads wouldn't get too far out of whack, but futures still lagged behind at all three exchanges. The government reduced its forecast of ending stocks, but by less than expected, to 654 million bushels. While feed and residual usage went up in line with USDA's September 28th grain stocks data, exports a weaker too, despite a reduction of almost 230 million bushels in world production. Output around the globe could go down further because USDA is only starting to cut its estimate of yields in Australia. Still, there's no sign that foreign buyers are turning to the U.S. yet. In fact, I believe the best hope for old crop rallies is on fears that new crop production is threatened by dry condition on the northern end of the hard red winter wheat belt. But it will be hard to rally the market on that prospect until 2013. Storing 2012 crop wheat over the winter may not be worth it, with the top end of my selling ranges at 916 Chicago, 951 Kansas City, and 984 Minneapolis. Those prices are only 30 to 40 cents away, which is a sign of caution. So I like making incremental sales with HDAs towards the top of the recent trading ranges than waiting for basis to strengthen into December delivery. With good base price guarantees from revenue protection crop insurance available on winter wheat, there's no need to get overly aggressive on pricing 2013 production. Still, getting bushels that won't have protection due to your APH and coverage percentage seems like a prudent thing to do. Well, that's all for this week. We'll have more on just how this rally plays out on the next edition of The Buzz.